Lehman Brothers and the global financial crisis, when the music stopped. September 15, 2008. Just after dawn in Manhattan. In front of a glass and steel skyscraper at 745 7th Avenue. People in suits are lining up with cardboard boxes. Some carry framed photos and desk plans. Some have only a laptop and a jacket draped over an arm. A few look embarrassed, like they have been caught in a disaster they did not understand until it arrived. A few hours ago, this building housed one of the oldest, most storied investment banks in the United States, Lehman Brothers. Now, it feels like a different kind of crime scene. No police tape, no flashing lights, just a collapse that had been building for months, made suddenly visible. The TV banners in the lobby and in the diners nearby say plainly, Lehman Brothers files for bankruptcy. Behind that headline sit a century and a half of history, a decade of financial engineering, a housing bubble, a web of derivatives, and a modern failure that is less about stupidity than about trust. Because in finance, trust is not an emotion, it is a funding model. Lehman Brothers does not start in a skyscraper. It starts in a shop. In 1844, Henry Lehman, a German Jewish immigrant, opens a dry goods store in Montgomery, Alabama. He sells cloth, tools, everyday goods. His brothers, Emmanuel and Meyer, join him a few years later, and the sign outside eventually reads Lehman Brothers. Their customers are farmers, many growing cotton, and in the early American South, cotton is not just a crop. It is a form of payment. Sometimes farmers pay in cash. Sometimes they pay in cotton itself. The brothers begin accepting cotton as payment, then as collateral, and soon they are doing something more than retail. They become middlemen. They help move cotton from southern growers to northern mills and global buyers. And they learn a lesson that echoes forward for more than a century. If you sit between producers and capital, you can earn not only on what you sell, but on how you finance, insure, and broker the flow. After the Civil War, the center of gravity shifts. The firm moves closer to New York, closer to the exchanges, closer to the machinery of finance. Over time, Lehman evolves from a family partnership into a modern investment bank, underwriting securities, advising companies, connecting businesses to pools of investor money. It survives panics, recessions, wars, and the Great Depression. It becomes one of those names that feels permanent. The kind of firm that will still be there tomorrow because it has always been there. And that is the first dangerous thing about history. It can make you confuse longevity with invincibility. Fast forward to the late 20th century. Wall Street changes shape. Deregulation loosens constraints. Technology accelerates trading and communication. Derivatives grow from niche instruments into a global language of risk. Investment banks transform into publicly traded corporations with shareholders to satisfy, quarterly earnings to hit, and compensation systems that reward volume and profit now more than resilience later. Lehman goes through restructurings, including a period inside American Express, and then spins out again. By the late 1990s and early 2000s, under leadership like Dick Fuld, it rebuilds itself as a lean, aggressive investment bank with a powerful fixed income franchise. Fixed income sounds tame, like government bonds and pension portfolios. But in the early 2000s, fixed income on Wall Street means something else. It means mortgages, pools of mortgages, securities built on top of those pools, securities built on top of those securities. It means turning millions of individual home loans into something tradable, sliceable, and, on paper, safe enough to be bought by pension funds in Europe, insurers in Asia, and banks everywhere. Lehman is not alone. Every major bank builds versions of this factory. Mortgage originators feed it. Ratings agencies stamp the outputs with letters the market treat like truth. Investors hungry for yield keep buying. The assembly line hums. But Lehman becomes particularly exposed because it does not just manufacture the product, it keeps a lot of it. It owns mortgage lenders. It holds inventories of mortgage-backed securities and related structures. It uses leverage, borrowed money, to amplify returns. As long as home prices rise and the machine keeps moving, the leverage looks like genius. It boosts return on equity, juices profits, and turns executives into legends. On paper, it is beautiful. In reality, it is brittle. To understand the danger, picture how the machine works. Start with a single mortgage. A family in California, Florida, Nevada buys a house with a loan that begins with a low teaser rate. Documentation may be thin. Income may be stretched. Brokers are often paid for volume, not for long-term performance. That loan does not sit quietly on a local bank's books for 30 years. It is sold. It gets pooled with thousands of other mortgages into a mortgage-backed security. Homeowners' monthly payments flow into the pool, and then the pool is sliced into tranches. Senior tranches get paid first and are designed to look almost bulletproof. Lower tranches take losses first and are paid later, if at all. In theory, this distributes risk. If some borrowers default, the losses are absorbed by the bottom first, protecting the top. But the machine does not stop here. Wall Street takes the riskier tranches and repackages them into new products called collateralized debt obligations, CDOs. These CDOs have their own tranches, and through assumptions about diversification and default correlations, pieces of these second-level products are also rated AAA. It is as if risk is being recycled into safety. The system relies on models that estimate how likely it is that many homeowners default together. A key assumption is that housing markets in different regions will not all fall at once. Prices might soften in one city, but surely not everywhere, surely not nationally. And that surely becomes embedded in spreadsheets, ratings, and investment mandates until it feels like a law of nature. To a trader on Lehman's floor, the mortgage is no longer a kitchen table conversation and a set of keys. It is a spread on a screen, a tranche label, a coupon payment, a duration profile. Human lives turned into cash flows, and cash flows turned into tradable objects. Abstraction itself is not evil. It is how systems scale. Without abstraction, you do not get capital moving efficiently or mortgages available to millions of people. The problem is that abstraction also hides weak points. And when everyone is rewarded for keeping the machine running, weak points become part of the design. Why does this machine grow so large? Because almost everyone in the chain earns something when volume expands. Mortgage brokers earn fees for originating loans. Banks earn fees for packaging them. Investment banks earn fees for structuring and selling securities. Rating agencies earn fees for rating them. Investors earn yield that looks slightly higher than government bonds, but still safe, at least on paper. Global conditions are also perfect for a boom. Interest rates are low after the dot-com crash and 9/11. Capital from trade surplus countries seeks returns in US assets. Policies encourage homeownership. Consumers begin to treat houses not just as shelter, but as wealth. In that world, rising home prices stabilize the entire machine. If a borrower struggles, they can refinance. If a loan looks shaky, rising prices provide an exit. The upward motion makes risk look smaller over time. The boom becomes self-justifying. Then, quietly, the music starts to slow. Home prices stop rising. In some places, they flatten. In others, they fall. Borrowers with adjustable rate mortgages face resets. Monthly payments jump, defaults tick up, foreclosures follow. The underlying loans are not as safe as the models assumed, and worse, the defaults are correlated. Whole neighborhoods experience the same pressure at the same time. Investors begin asking uncomfortable questions. How much are the securities really worth? If I want to sell, who will buy and at what price? This is where the difference between a public stock and a structured credit product becomes fatal. A stock has a visible market price. A complex mortgage structure trades infrequently. Its value is often marked using models, dealer quotes, and assumptions. When fee rises, those marks become contested. Spreads widen, haircuts on collateral increase. Senior tranches that were thought untouchable begin to feel exposed. The safe story wobbles. For Lehman, wobble is deadly because its business model depends on confidence. Confidence is operational. It is your ability to borrow short-term money tomorrow. An investment bank's life is a balancing act. On one side are assets, so mortgage securities, loans, derivatives positions, trading inventory. On the other side are liabilities, the money borrowed to hold those assets. Lehman funds itself heavily in short-term markets, especially through repurchase agreements, repos. In a repo, Lehman effectively borrows cash overnight and provides securities as collateral. The next day, it buys the securities back at a slightly higher price. That difference is the interest. As long as lenders trust Lehman and trust the collateral, this works. You roll the funding day after day, like a treadmill that never stops. But if doubt creeps in, lenders demand more collateral. They raise the haircut, or they refuse to roll funding at all. This is a run, but not a line of depositors outside a branch. It is a run by institutions, executed through spreadsheets and calls. A silent, professional panic. For a highly leveraged firm, even a small disruption becomes existential. If you cannot fund your assets tomorrow, you are forced into fire sales. Fire sales push prices down. Lower prices trigger more margin calls. More margin calls force more selling. The loop tightens. In early 2008, Bear Stearns collapses under a similar dynamic and is pushed into a rescue deal with JP Morgan Chase, backed by the Federal Reserve. Lehman watches that and tries to convince the world it is different. But markets learn to smell weakness. Through spring and summer 2008, Lehman tries to save itself. It raises capital. It insists publicly that its balance sheet is sound. It explores asset sales, restructurings, spin-offs of toxic portfolios. It searches for a buyer. There are talks with foreign banks, negotiations with Barclays, conversations with Bank of America, weekend meetings, emergency calls, people doing spreadsheet triage at 2 a.m. But the market's patience is thin. Short sellers bet against the stock. Rumors fly. Each negative headline makes funding harder. Each funding strain makes headline worse. Inside the firm, employees live in a strange dual reality. Some clinch to defiance. Lehman has survived worse. The market is overreacting. Others quietly update resumes and call friends. Regulators and officials watch closely. They know Lehman is entangled in derivatives and counterparty relationships worldwide. They understand that failure could spark chain reactions. But there is political fatigue and moral anger. The idea of bailing out another investment bank is toxic. Ordinary homeowners are suffering. Elections loom. So the question becomes not just financial, but political. Where do we draw the line? In mid-September, key players gather for a decisive weekend at the Federal Reserve Bank of New York. Wall Street CEOs and government officials meet to find a buyer or orchestrate some kind of controlled resolution before markets reopen. The atmosphere is technical and tense. People argue about valuations, collateral, legal structures, and risk. But underneath the detail is a raw fear. If the system sees one major bank allowed to fail, what happens next? Potential buyers hesitate. They want guarantees. They want clarity on the ugliest assets. Regulators hesitate. The clock ticks toward Monday. And at a certain point, the US government's message becomes clear. There will be no public money used to save Lehman. If a private buyer wants it, they must take the risk. No one does. On Monday morning, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy protection, the largest bankruptcy in US history. The assumption that a large, interconnected institution will always be rescued shatters. It is not only a corporate failure, it is a psychological rupture. The immediate aftermath is chaos, and it starts in places most people do not watch. Lehman's counterparties scrambled to understand exposures. Some had used Lehman to clear trades, hold collateral, run prime brokerage accounts. Now they are unsure what assets are theirs and what is tied up in bankruptcy proceedings. The plumbing jams. Then, a corner of the system that is supposed to feel like cash starts to crack. Money market funds. These funds hold short-term debt, including Lehman paper. When Lehman fails, that paper collapses. One fund breaks the buck, meaning its value falls below $1 per share. That phrase sounds technical, but it triggers something primal. If a money market fund can lose money, what is safe? Panic spreads. Investors pull cash. Commercial paper markets seize up. Interbank lending tightens. Banks stop trusting each other's balance sheets because nobody knows where the toxic exposures are hiding or how to value them. If Bear Stearns was a heart attack warning, Lehman is cardiac arrest. Central banks and governments swing from reluctance to intervention. AIG is rescued. Emergency lending facilitates expand. Capital injections follow. Programs like TARP are launched. The state becomes the backstop because the alternative looks like financial gridlock. Yet, even with intervention, the damage is profound. Lehman's failure does not just destroy one bank. It changes the perceived rules of the game. It is tempting to turn Lehman into a simple morality tale. Greed, hubris, recklessness. Those elements are real. Lehman took too much leverage. It concentrated in mortgage assets. It relied on fragile short-term funding. It rewarded short-term profit and treated high returns as proof of skill rather than as a warning. But Lehman is also a system story. It represents the belief that risk can be sliced, packaged, and sold until no one holds too much of it. The comfort of AAA labels stamped onto structures that were only as safe as their assumptions. The idea that liquidity is permanent, that funding is something you roll automatically, that the market will always be there tomorrow. And it represents the danger of complexity without transparency. When the music plays, complexity looks like sophistication. When it stops, complexity looks like confusion, and confusion kills trust. The system did learn, even if it learned the hard way. After 2008, capital requirements rose, forcing banks to hold more loss-absorbing equity. Liquidity rules tightened, pushing firms to rely less on fragile, overnight funding. Stress tests became routine, forcing institutions to imagine ugly scenarios instead of assuming smooth ones. Parts of derivatives markets moved towards central clearing, reducing some counterparty uncertainty. Regulators pushed large firms to prepare living wills, plans for how they could fail without taking the system with them. None of this makes crisis impossible. Finance is too entangled with human behavior, incentives, and politics. But it means the shock of Lehman was not only destruction. It was information, a brutal signal that reshaped rules. And as the old system tightened, a different kind of builder saw an opening. Even before Lehman collapsed, another financial story was already moving, quieter and more software-shaped. In the 1990s and early 2000s, PayPal figured out how to move money on the internet, layering a digital wallet and fraud controls on top of bank accounts and card networks. Its alumni gathered across Silicon Valley with capital, experience, and a worldview. Many financial products are not fundamentally mysterious, just poorly engineered and wrapped in friction. Some build rockets and cars, others stayed close to money. They build tools for online payments, lending, investing, remittances, and mobile wallets. They ask questions that sound almost naive, which is why they are powerful. Why does it take days to move money when information moves instantly? Why is accepting payments still a paperwork marathon? Why do cross-border transfers feel slow and expensive in a world of instant messages? In the 2010s, Stripe would make it easier for a startup to accept payments with a few lines of code than it was for a small shop to secure a merchant account through a traditional bank. Neobanks would offer slick interfaces to accounts. New lenders would try to automate decisions and reduce friction. They were not overthrowing banks, they were building new interfaces on top of them. But interfaces change behavior, and behavior changes power. And in a way, all of that traces back to that morning in September 2008, when a great name fell and the world realized the plumbing could break. Lehman Brothers is the day modern finance becomes visible to people who never asked to study it. Leverage, short-term funding, and confidence balanced on assumptions that can evaporate in a weekend. It is the day the music stopped and everyone heard what had been hidden beneath the melody.